Hello, good morning. Today our guest is Dr. Hunter Harris, and we're going to be talking about the interesting topic of slavery and insurance. Hello, Dr. Harris, how are you doing?
I'm doing great, thanks. Thank you for having me on the podcast.
Yes, and the title of your article is Underwriting and Investing in Slavery, the London Assurance Company in the Atlantic World. Transatlantic slavery. What was transatlantic slavery, and why was insurance so important during the days of slavery?
So, transatlantic slavery is a huge topic, but just to give what I think is probably the 30,000 foot overview, it's the movement of enslaved people from Africa to the Americas from the really the late 15th, early 16th century until the 19th century. And the places where people went were predominantly Brazil, the Caribbean, North America, and places like that.
But why was insurance so important to the business of slavery? Was it because of the risk associated with the transatlantic slave trade?
So I think so. I think insurance was important in this age, and even in our current age for any form of trade. We're seeing that now with what's going on in the Strait of Hormuz and President Trump's plans for reinsurance to try and get ships going through the strait. In the 18th century, the period about which I write, trade was riskier than it is now. This was the age of sail, when ships are made of wood and they're dependent on winds and currents to move them around and have a lot less control and a lot less safety. And then there's also the fact that the slave trade is inherently, or was inherently, a very risky business. Ships had to spend lots of time on the coast of West Africa where they would pick up captives, and they were subject to disease and other things that could go wrong there. It was a long crossing across the Atlantic, and people are crammed into these ships in really high and really horrible conditions. And so the risk of rebellion was really high on slave ships as well. So there are a number of risks that slave traders faced, and they turned to marine insurance to help manage those.
I'm happy that you mentioned rebellion. You're not here to talk about rebellion, but for those of us who are not acquainted with that period of history, there were rebellions on slave ships. Some scholars argue that when slave ships were flooded with men, rebellions were more problematic. It was difficult to encourage social cohesion. This paper was published in an academic journal by two scholars. Later in the interview, when I remember her name, I'll tell people where to go and read them. I don't like to mispronounce people's names, so that's why I'm not calling
No,
the
I,
name of the writers.
I understand the struggle. There's so much research out there. It's hard to remember everything at the tip of the
Yes,
tongue.
and the recent research on mortality is interesting. Other than people like Herbert Klein, there are some younger scholars who have written on slave mortality and its relationship to not to slave technology, but to ship technology, and why mortality declined when it did. It's really interesting research.
Mhm. It sure is.
Yes. So slavery and insurance is now a topical issue because some people argue that insurance drove the slave trade. Others say that the slave trade drove insurance. I tend to side with the argument of David Richardson. The insurance drove the slave trade. You have written on the topic. What's your position based on the research that you have done and what you have written in the article?
So I haven't conceptualized this in one driving the other. I think they both need each other in different ways. Marine insurers need voyages and risks to underwrite. That's how they make their money, and that's their business. And slave ship owners need a tool to offset some of the risk they run. So I think there's kind of an elective affinity between the two things rather than a causal relationship. Um, but I was interested in this article and looking at the importance of slavery to London's marine insurance markets in the earlier 18th century. And by this, I meant not just the slave trade itself, the movement of people from Africa to the Americas, but also the ancillary trades. Um, ships that are going to places like Jamaica to pick up cargoes of rum and molasses and sugar that are produced by enslaved people, and then bring those back to Europe or North America, which is part of the wider Atlantic economy of slavery. So I was interested in finding out more about this. There are some very good articles already in existence. You mentioned David Richardson, and he and Robin Pearson have an article about marine insurance in the slave trade in the later 18th century. And I found some archival sources from earlier in the 18th century that I thought could help shed some light on these bigger questions and help us kind of construct the beginnings of a change over time narrative, or helping us to see how things might have changed, might have been different over the course of the 18th century.
Interesting. I have been following the slavery and economic growth debate for some time. So this
Mhm.
is why your paper is so interesting. I ensure that I have access to all the latest literature on the topic, whether I agree with it or not.
Well,
So,
it's there's so much literature on the topic that's coming out now. I think it's a real exciting subfield within history, and so it I find it hard myself to keep up with it because so much good work is being done. Um,
so the focus of this conversation is the London Assurance Company. So give us some more details. What was the London Assurance Company? Why was it formed? How did it function? Those basic questions.
Sure. So the London Assurance Company is one of the two chartered insurance companies in England in the 18th century. So prior to the rise of what we call general incorporation in the mid 19th century, companies needed a charter from the government to be able to form a corporation. It's a very specific legal privilege. And so in 1720, two groups of investors form insurance companies, the London Assurance and the Royal Exchange Assurance. And they're existing in this insurance market with the private underwriters at Lloyd's. Lloyd's of London is famous as the world's biggest and most prominent insurance market, and it's really getting going in these early decades of the 18th century. But there aren't companies participating in it. It's individuals and perhaps small partnerships of 2 or 3 men who are putting their capital at work. So the London Assurance and the Royal Exchange Assurance are the only two large corporations that are allowed to participate in the marine insurance market in the 18th century. So it was chartered in 1720, initially to do marine insurance business. It was backed by a group of investors and merchant capitalists who had been merchants and financiers in London for a number of years. And it's also coming onto the market in this really heady times around the South Sea bubble. I think the South Sea Company is probably something we'll loop back to at a later point in the conversation. But just to say now that in 1720, the South Sea Company is every investor's favorite stock, and its share prices are going through the roof. But people are afraid that it's a bubble and want to keep up the price. And so what's called the Bubble Act is passed by Parliament that charters the London Assurance and the Royal Exchange Assurance corporations, but then doesn't let any other corporations form. So between the London Assurance and the Royal Exchange, they have a monopoly on being a corporation to engage in marine insurance, and they're existing in the market with the private underwriters at Lloyd's at the same time.
All right. Do you know what I find fascinating, Hunter? I,
What's
I,
that?
I I've always wondered, why was the business of imperialism in Europe so efficient? Europeans built trading companies, there were banks and insurance companies. Why didn't other places scale at that level? I've always found that question
Mm.
interesting. I think
That
that's something that a young historian like yourself should ponder.
that is a really interesting question, and I suppose it requires a really good comparative historian who knows a lot about Europe and other places. Although I will say that I think thinking of these European ventures as being very efficient isn't always right. If we
Because
think
they
about
weren't like the Dutch West India companies. They eventually flopped.
the Dutch West India Company flopped, the South Sea Company flopped. The Company of Scotland with the Darien schemes flopped. If we look at early English colonization in North America, um, most of the or many to most of the initial settlers in Jamestown and Plymouth suffered starvation and died. And I don't think the investors ever got their money back. So there's a really long period of learning and experimentation and development. And so by the time I'm picking up this story in the 18th century, where the English have been engaging in imperial ventures for over a century. So they're a little better at doing long distance trade and imperialism at this point than they are 100 or 150 years earlier.
Exactly my point. I don't think economists, people who study economic history, they understand the causal mechanism from slavery to profitability. I think that many of these studies are observing the wrong variable because, as you said earlier, these institutions were only efficient and profitable for a time, and they eventually flopped. So they might have played a role, but they were not the causal role. Then in England, the textile sector was innovative and productive, so it could respond to demand from the plantation economies. So as I said before, I don't think people understand the causal mechanism from slavery to wealth.
Yeah, I think it's a complex one because there's both the, let's call them, the direct profits from slavery and the slave trade, but then there's other more indirect things like as you mentioned, how the plantation colonies provide really huge markets for Britain's textile industries, and the same for ironware and manufactured goods. So there are lots of causal paths through which profits can flow, and sometimes I think it's not even profits that's the most important, but it's providing markets and business and stimulus. Whether or not they make money or not is sometimes a second order question.
So this London Assurance Company, how did it make money from marine insurance and other sources? Well, it obviously made marine insurance. It obviously made money from marine insurance, so that question was not phrased properly. But other than marine insurance, what were its other sources of wealth and investments?
So it's marine insurance was its original purpose as a business company. And then a few years later, in the mid 1720s, it started getting into other lines of insurance, predominantly fire insurance and life insurance. And those, at least in the period that I've been writing about, were much smaller business lines compared to marine insurance for the London Assurance Company. But insurance companies, I think, as a rule, are allocators and investors of capital, as well as providers of risk management services. In the business of insurance works from the fact that underwriters take the premiums and they invest them, and they can earn returns on them. And from that pile of premium money they have, they can pay out losses. And so the London Assurance Company, excuse me, has a really large investment portfolio that it earns money off of as well. And I have data from the 1730s that show that its investment income is certainly more reliable and about the same same size as what it's earning from marine insurance policies.
All right then, and I want some more information on its investments in other companies. So you earlier you mentioned the SSC, that company.
That's right, the South Sea Company. So the South
Yes.
Sea Company, we're talking about it right now because it's one of the largest investments that the London Assurance makes. The South Sea Company is another one of these chartered corporations, chartered by the British state in 1711. And originally, it's a way to help manage war finance. Britain had been fighting the War of Spanish Succession on the European continent, and was racking up massive bills, and it needed some sort of creative ways of financing it. And a group of investors put forward the South Sea Company as a way of helping manage that. At the end of the War of Spanish Succession, Britain received the Asiento, which was the monopoly right to sell slaves into the Spanish Empire. And the British state gave that right to the South Sea Company. So the South Sea Company was initially a government finance vehicle that had been given monopoly privileges of trading to the South Seas, that area around South America and the Caribbean. and then it also had this really economically valuable privilege of being able to sell slaves to the Spanish Empire. And the London Assurance Company was a consistent investor in the South Sea Company in the 1730s, from what I can tell. There was a certain amount of interpersonal links of the same men sitting on boards of the two companies or doing the same type of business. And the London Assurance Company owned shares in the South Sea Company. It owned various annuities and bonds from the South Sea Company. So the South Sea Company is an important part of the London Assurance's balance sheet, and I think where it's getting its investment income.
How profitable were these investments?
So that's a really difficult question to answer. And the sources I was working with in the archives just didn't let me answer that. I could see how much investment income the London Assurance received. I could see how big its holdings of South Sea Company instruments were, but I really wasn't able to pin down how much money it was getting from the South Sea Company directly. I think in a kind of back of the envelope calculation, it was probably 15 to 20% of its investment income was coming from the South Sea companies, maybe more. But it's one of those things that would require a lot more time in the archives to pin down more exactly. So I can't be more precise than that.
I read your paper obviously, and based on what I've read, it sounds that initially its investments were profitable and that it made some money from its investments in slave based companies or companies that were related to the business of slavery and the slave trade.
Yes, absolutely. I think the London Assurance is underwriting slave voyages and voyages to plantation economies based on slavery, and it's making money from that. It's making loans to individuals who are engaged in trade and pledging shares in South Sea Company or Royal African Company, both slave traders. So it is making money from its investments to slaving companies in various ways.
Was it a global company? We mentioned trade with the Spanish earlier, but let's talk about the Iberians more broadly. How involved was the LAC in the Iberian market?
So that was one of the surprising findings from my research, is that the London Assurance was far more involved with in ensuring trade within the Spanish and Portuguese empires than I would have expected. As historians, we have these models of various empires as being kind of separate lakes that are protected from each other. And in theory, Britons couldn't go and trade within the Spanish or Portuguese Empire other than in some special circumstances. But what I found was that the London Assurance was actually underwriting a pretty high proportion of its marine insurance policies were going to vessels within the Spanish and Portuguese empires. And it was getting that business in London. People were writing to it there or to their agents there to make the insurance policies with it. But it also had merchant agents in Cadiz and in Lisbon who were lending money to Spanish and Portuguese merchants directly there. So there's a pretty high degree of entanglement between the London Assurance's business and trade within the Iberian empires that I thought was really interesting.
Iberian empires. Well, I found something really interesting in the paper, and I'm going to read it for the audience. Slave trading voyages therefore disproportionately contributed to the London Assurance Company overall revenue, while voyages to Africa accounted for only about 1.5% of all voyages underwritten in the sample. Those same risks made up 7% of the LAC's premium revenue. 1.5% of the voyages underwritten in the samples. What is this statement really saying? Was this
So
Did the LSE in, engage in businesses that were more important than slave trading? So were slave traders not the biggest clients?
So I don't think slave traders were the biggest clients, But there's a distinction between the number of voyages and the revenue that the company got from them. So earlier we were talking about how slave trading voyages were really risky. So the insurers would charge a higher premium as a percentage of the value insured. So even though slave trading voyages were numerically fairly small, they accounted for a larger proportion than we would think of that basis of 1.5%, because the risks are so high, and they're charging greater premiums to insure those risks.
That's so. Could you give us an idea of some of its other clients? You don't have to call names or be specific, but other than slave trades, what
So,
or who are the other clients?
so it's doing a little bit of, I mean, it's doing some of everything. A lot of it's the business that it's insuring is what I in the paper called intra-European trade, and that's things between Britain and Ireland, between Britain and France, Britain and the Mediterranean, all of that trade within Europe. It's ensuring voyages to Newfoundland and to the northern colonies, places like Boston. Um, it does some insurance for ships that are going to India and Canton in China as well. Numerically, that's fairly small, but like the slave trade, these are long voyages that are quite risky. So it ends up being, you know, a moderate revenue producer from it. So I think its business reflects the wide variety of marine trade that Britons are engaging in or involved with in one way or another at this period of the 18th century.
I should have posed this question earlier when we were talking about the Iberian trade, but since we're on the topic of the diversity of clients, I am going to pose a question that you pose in your article. Why did the London Assurance Company find such a ready market for their services in Spain and Portugal?
So that's
On page nine. This is on
on
page
page 9. All right, let me go check page 9. I think this was something that I could only suggest some possible explanations, and there is no undisputed answer. I think there are a number of things. One is that the men who are sitting on the LAC's board often have a lot of trade themselves to Iberia, so they're merchants trading to Spain and Portugal, and so they can bring in business from from their commercial connections there. So there's that kind of interpersonal networks idea. There's also what we could call kind of regulatory dynamics in the Spanish Empire, where Spanish commercial law limited the amount that any merchant or ship owner could take out in insurance for a given voyage to probably, I think it was 2/3 the value of the cargo. So they couldn't insure the risk entirely. So we could imagine a world in which Spanish ship owners would insure that 2/3 locally and then insure the other third with the London Assurance or other British underwriters, or they might go to Britain for the whole thing. And then there's some work on the Spanish marine market, which I don't know as well, that it's relatively underdeveloped compared to that in London and Amsterdam in this period. And so shippers would find they could get better rates or easier cover in the marine insurance centers of London and Amsterdam than they could locally. So they're going to London for their business for probably a combination of those reasons.
Interesting. Later on in the interview, I will be asking you about your broader research because I like business history and legal history, and you were written on commercial law.
That's right.
And yes, yes. And in your paper, you said Spanish commercial law limited the amount that any merchant or ship owner could take out in insurance on any given wage. On any given voyage. And
Mhm.
before that, it is said there were also local dynamics that affected the demand for foreign insurance from Spain. So just put this into context for our listeners.
Yeah. So this is again um, educated hypothesis about what's going on,
That's
but
okay. I
But
know
this,
academics only like to speak when they are 100% sure, but nothing is wrong with an intelligent speculation.
yeah. So I mean, I think there's there again a number of things going on. One is that from what I know, it seems that the local insurance markets in places like Lisbon and Cadiz, which are the main ports for Portuguese and Spanish Atlantic trade, respectively, are underdeveloped compared to the major financial centers in Amsterdam and London at this time. There's also this regulation in Spanish commercial law that ship owners can't insure more than two-thirds the value of any voyage. So, if they want to insure their whole voyage, so it's not a total loss, should anything bad happen, they have to go elsewhere for that insurance. And I think that's what's driving part of the business to the London Assurance Company.
The London Insurance Company is an interesting case study because, based on what you have said in the article, its financial history seemed rather mixed. Why was it not more successful?
So that's another great question. And the way historians often tell the story of insurance in London is that the private underwriters at Lloyd's kind of outcompete the two corporations, London Assurance and the Royal Exchange Assurance. And I haven't come across anything in its archives that would lead me to think otherwise. In a market with lots of individual participants, you're going to have some people who are willing to take risks that others aren't, who are willing to put their capital at risk that a big company might not be willing to do so. And so I think the kind of the market dynamics that are functioning within Lloyd's mean that its underwriters can be a little bit more efficient than the big corporations that have processes, and the committee has to decide on what risks to underwrite. Um, so there are, I think, kind of economic reasons for the relative success of the Lloyd's underwriters over the chartered corporations. But one of the things I talk about in the paper is that the London Assurance and the Royal Exchange Assurance have a rough first few years in business. They start up in 1720, and a lot of their capital gets invested in the South Sea Company initially, and then that bubble bursts. So the capital that they're supposed to use to be able to finance their underwriting gets severely reduced in their first year, and they can't enter the market really aggressively. The London Assurance Company also has a problem where it apparently insured 12 ships going to Jamaica in that first year that it lost, that were lost at sea. And so that also depleted its capital available for underwriting. So I think this combination of kind of the economics of the Lloyd's market versus corporate decision making in the companies and the hits to their capital in the first year or so helps explain the divergence between their fortunes, at least in this earlier period.
Earlier in the interview, you made an important point, and some people might not appreciate it, even if they are quite familiar with economic history. A chartered company, a limited liability company. So we know what's a limited liability company. The Brits had chartered companies, but it was Americans who initiated the revolution in the organization of companies. Some people, when they hear the term charter company, they assume that it's the typical limited liability company. They
Mm.
don't appreciate that the liability company is more independent, and it was the Americans who built on that British legacy. So just put that into context for us.
Yeah, so it's one of these interesting developments in economic and legal and business history that the corporation, this thing that we think is almost natural and ubiquitous in our lives, is actually an invention of the business corporation as we know it now is an invention of the 19th century. So in the period I'm writing about, in the earlier period, there's no way to form a corporation. If you and I, Lipton, wanted to form a business, we could be a partnership, but we couldn't form a corporation unless we went to the government and said, please give us a corporate charter that will allow us to have limited liability, that will allow us to have transferable shares and other privileges. Those privileges aren't available to anybody who wants to start a business. They're only available through the government's grant. So the London Assurance and the Royal Exchange Assurance are able to secure these corporate charters and have these privileges of transferable shares, of limited liability for their investors, of legal personhood that the individual underwriters don't have, and that most businesses don't have in the 18th century. And then in the 19th century, in Britain and America, it's a longer process of states giving business people the ability to incorporate, to form business corporations directly without having to ask for a charter from a state government or the federal government or parliament here in Britain.
Exactly. And the limited liability company really revolutionized the business landscape.
Yeah, well, I think the limited liability company and the corporate form more generally allows businesses to do things that they can't do when they're smaller scale. They can pool together a lot more capital, and investors have security that the money they invest is all that they're going to lose. Their personal assets aren't going to be liable if the business fails and creditors are looking for repayment. You know, business
And
corporations can hold land more easily, can sue and be sued to kind of do all these aspects of everyday business life that we take for granted, but is much harder to do without a corporate personality.
and the corporate charter was not cheap, it was expensive.
That's right. That's right. You know, it had to be secured through lobbying and favors and sometimes bribes to powerful individuals or sometimes fees. So I think the London Assurance Company, let me just check my notes, you know, it spends something like £100,000 as a, or 150,000 as a payment to the British state in order to receive its corporate charter.
Yes,
And
it,
this
it
is,
paid that fee to keep it, and the original cost was £300,000, but it had to pay that fee at a later date to keep it.
that's right.
Yes,
Yes. Yes. So the corporate charter isn't cheap, and it's a massive privilege, and it gives the entrepreneurs behind the London Assurance lots of privileges and advantages that individual merchants and investors don't have.
yes. It says facing financial hardship in 1720, the company negotiated a reduction in the amount it owed to 150,000. So it had to reduce it to 150,000 to keep the charter on its books. I've read this and I'm saying, how many companies were not started because of the charter? £300,000 in
Mm,
1720 was a lot of money.
it's a lot of money. It's a lot of money.
Exactly, that was a lot. If you had £300,000 in 1720, you were like Bill Gates.
Right. Right. It's a huge sum of money. And I think it's one of these questions that's really fertile for historians working at the intersection of legal history and economic history, because there are ways of forming business enterprises through kind of common law or equitable devices like the trust that allows people to pool capital and conduct businesses. But is it as efficient? Is it as cheap and easy to work with as a corporation? No. And so, one of I think a big question for business history in Britain in the 18th century is, you know, what would have happened had more companies been able to secure incorporation, had the Bubble Act not been passed?
So, Hunter, this means that you are going to write that paper because, to my knowledge, I have not seen a thorough examination of that issue.
So some people have worked on it. The name that comes to mind right now is Ron Harris
Yeah,
and
well, I
his
know
book.
Ron Harris. He writes on government and early statist policies. So I know Ron Harris.
Yeah, so his book, Industrializing English Law, looks into this question.
Okay, and does he give specifics?
He does. I can't remember them all, but
Oh,
you know,
okay,
it's
okay. But he
but it's
does.
but
Okay.
it's a big detailed book about you know the ways in which businesses organize themselves legally without the corporate form.
Okay, okay. Well, Ron Harris is an interesting economist. I'm familiar with his work, but that's a book. that was written some time ago. I'm talking about a one paper, like a quantitative paper or a
Oh,
historical
what?
paper, just saying this is the issue, examining
Oh,
it by itself. I've never seen a paper like that.
no, I'm not. Nothing's coming to mind right now. I'll have to think about this. As we were saying earlier, there's so much research that comes out, and just trying to keep abreast of everything and remember what one's already read um,
Yes.
is a challenge in itself.
Was it feasible? This is not a question that you interrogated in your paper, even though it's contextualized. But was it feasible to offer loans to individuals? Because you do say that the LAC did offer loans to individuals. Was that a good business move?
Was it a good business move? In aggregate, it probably was, since the LAC made money from its investing and its loan portfolio. I'm sure some of those individual loans did not turn out uh, as they wanted, but the LAC, stayed in business and kept afloat, and it seems to, and it did, in fact, make a lot of money through its investment portfolio, and those loans to private individuals were a considerable part of it.
Yes, like one private individual, he is listed as being a Mr. Robert Aston. So
Mhm.
the company lent Robert Aston just over £1,000 on three bills of exchange. What's a bill
Mhm.
of exchange?
Uh, the bill of exchange is really fascinating financial instrument, and it might help if we think about it as an early. It's something like an early form of a check, like we used to get from banks. Um, so, a bill of exchange is strictly an order to pay. So, if you and I are merchants who do business with each other, say you're in New York and I'm in London, and you order, and we have standing accounts with each other, and you order something from a manufacturer somewhere in Britain, you could send them, you would pay for it through a bill of exchange, where you would send this bill to me and it would say, dear Hunter, pay this person this amount of money, on this date, and put it against my account. So it's a financial instrument that allows people to order payments across long distances, um, and the payment is often delayed so people could borrow against them, which is what Robert Aston is doing here. He has the bills, so the money is coming in, but he hasn't received the money yet. So what he's done is he has essentially pledged them over to the LAC in return for the cash up front, and then the LAC will get all of their money when the bills are paid.
Interestingly, the company was also invested in fire and life insurance.
That's right. Earlier I mentioned how the company faced some serious financial setbacks in its first few years. And so it went back to the British states and renegotiated a new charter for itself, or a additional charter that enabled it to participate in fire and life insurance. So earlier we were talking about how the corporate charter allows companies to do some things, but in this era they were relatively um, they were quite strict in what companies were and were not allowed to do. So the London Assurance Company's initial charter says it's a marine insurance company. It can engage in marine insurance. It doesn't say anything about fire or life. So it goes back to the Parliament and it gets a new charter that allows it to participate in those business lines, and it can expand in those industries from then on, from the mid 1720s. And it's not, I didn't really look into its business in marine, or sorry, in life or fire insurance, but I think they were never as big as marine insurance for the London Assurance in
Okay.
the years I was writing about.
And what do you mean by premium revenue for those who may not understand?
So premium revenue is the amount that the company would have collected in on policies. So to give like a simplified example, if I'm the London Assurance Company and you, Lipton, are a ship owner, and you wanted to insure £100 on a voyage, again, say from London to New York, and I'll tell you, okay, the insurance on that is going to be 3%. So the premium is £3 on a £100 risk. and that money would be paid into the LAC that it could then invest or and hold on to.
And 45% of the London Assurance marine insurance premium revenue came from slavery related voyages in 1725 to 1726. So imagine you're not listening to the interview earlier and you stumbled on it and I read that line. What should you think? How do you interpret it? I on this show I ensure that the people who are listening understand what we're saying. Even if it sounds simple.
Sure. That makes a lot of sense. So I think this is one of the big findings from the article is that I found a record book from the London Assurance Company that covered every marine insurance voyage they underwrote over a 12-month period in 1725 to 26. And I digitized them all and I added up all the numbers and categorized them. And I found that trade related to slavery, whether that's the slave trade directly, bringing people from Africa, or trade to and from the plantation colonies in the Caribbean, the money that they earned, that the London Assurance Company earned from that, the premium income that we just talked about in that example, was 45% of all of its premium income. And so
What
45% of its revenues for marine insurance, its biggest single business line, came from trade associated with slavery.
okay. What's a bond?
What's a bond?
Yes.
Um, I mean, a bond is it's an obligation to pay a set amount of money, um, isn't isn't it? So a bond promises future payments, and sometimes bonds have interest attached to them. So, say £100 bond would pay, I don't know, 3-4% interest annually, um, and then whoever lends that money would get the £100 back at the end of the bond's term.
Were bonds important in this business? In the
So bond
London Assurance Company business?
so bonds were really important in its investment portfolio. It held a lot of bonds from the British state and from the other chartered companies like the South Sea Company or East India Company and Bank of England. Bonds were a major way that the British state funded itself, as governments still fund themselves through bond sales, as do companies. And so the London Assurance Company was an active investor in bonds.
Interesting. The London Assurance Company, it had a global project. It was competitive. How aggressively did it compete with its competitors, or did it do business with its competitors? Because you mentioned the RAC, Royal African Company.
Mhm. So the Royal African Company is a slave trading venture, also based in London, and it's a client of um, the London Assurance. The London Assurance underwrites voyages for the RAC, and the London Assurance also invests some of its holdings in the RAC. Not a lot, from what I remember. So they're not really competitors. The London Assurance's competitors are the Royal Exchange Assurance that we've talked about a few times, and those individual underwriters who are congregating at Lloyd's in this period.
The RAC, like many businesses in this industry, eventually faded out too, for those of us who don't know.
Yes, that's right. Britain's two monopoly trading companies engaged in the slave trade, the RAC and the SSC, the Royal African Company and the South Sea Company, um, both eventually failed as businesses. They couldn't compete with private slave traders and had all sorts of management issues, which meant that by the mid 18th century, they were functionally defunct as trading companies.
We learned so much from slavery. From slavery, we learned that markets are superior to statism. The private traders were more successful than companies that benefited from government privileges.
Well, I think
So
it.
interesting.
Yeah, it's interesting. I mean, I think we see, the slave trade was such big business in the 18th century that it sheds light on um, economic themes that run throughout history. There were some corporations that were privileged by the government that were really effective and made money, like the Bank of England or the East India Company, than others that were less well run or were struggled to compete with private merchants like the RAC and the SSC. Something like the London Assurance or the Royal Exchange Assurance, was never quite a market dominant force, but they managed to exist for several centuries and have been absorbed into insurance companies that are still going today. So we see how sound management, how different industries change, how entrepreneurs respond to opportunities all really matters for the success of these organizations.
The Bank of England owned 599 slaves in the 1770s. Nobody escaped the allure of slavery and its profits.
I think that's right. Slavery was such big business in the 18th century, and there were so many opportunities for investing in slavery in one way or the other that many, that slavery was bound up with the early financial history of the city of London.
You mentioned that earlier in the text, the City of London as a source of funding for financial markets and the export of financial services. Even
Mhm.
today, even today, London is still successful. So I've been reading this piece and thinking about it, and there's this theme that keeps recurring in my head: equity investment. So when the London Assurance Company lent the London merchant Edward Turner £10,000 and took £11,000 of the South Sea stock as collateral, the London Assurance collected dividends on the stock on his behalf, and by March of 1731, the London booked a profit of £1,000 on the loan from the interest Turner paid. This is not necessarily equity investing, but there's some parallels between it and private banking. So banking to private companies. I think that's another line of research for somebody like yourself who is innovative. Yes, I'm giving you homework.
You're giving me homework. Yes, I'm going
Yes.
to be busy for the next decade doing all the projects we talked about.
Yeah, yeah,
Um,
yeah. It sounds a bit like private banking.
Yeah, well, I mean, I think it's also kind of corporate banking or commercial banking. I'm not a
Yes.
banker. I'm not going to go into the distinctions between them. But I think the London Assurance Company is an allocator of capital, as I said earlier, and people who have want of money come to it, and they pledge collateral, um, and and the London loans them money in exchange for that collateral, and they try and make money off of it. This is how the banking system works, and insurance companies are still great investors and allocators of capital today.
Are banks good for society? I think banks are indeed good for society. Finance is good. You mentioned it earlier. Finance allocates resources. People like to say England is suffering from the financialization of the economy. I say no. Finance is an area of the English economy that's competitive.
Oh, I'm just a historian of the
I know
18th
you're just a
century. I
historian,
couldn't
but
possibly
I,
answer
I
whether
think
finance is
I
good for
think finance
society
is
or
good.
not.
I think finance is good.
Well, I think like anything, we need to appreciate the benefits and drawbacks of everything. Um, right? We could probably both think of examples where financialization has led to good results and also to poor ones.
So when I was reading your paper, I looked at the footnotes, and this footnote is of particular interest. So I looked
Okay.
it up. It's the footnote where you quote Caroline Sissoko and Mina Ishizu,
Mhm.
preventing financial ruin. How the West India trade fostered creativity in crisis lending by the Bank of England. Yes, so I went
Yes.
to look it up. I'm not asking you for a lecture on the topic, but I think this is interesting because this writer and their co-author, in a strange way, they are finding the causal mechanism from slavery to growth. It was indirect. So slavery facilitated new innovations in financial markets. That's why this paper is so important.
Yeah, I think it's a really interesting paper because it shows how trade crisis and crisis in the West Indies leads to real financial innovations in the city of London at the end of the 18th century.
And what? So you what's your real area of history expertise? Commercial law, legal history.
Yeah, so I try and work at the intersection of legal history, business history, and economic history. And we've touched on some of those themes today. And I do that looking at the British Empire across the 18th century.
Yes, and for a while you were at Oxford. What did you do at Oxford?
That's right. So I was a postdoctoral research fellow at Nuffield College, Oxford, for 3 years, where I was working on a project about the connections between the city of London and slavery. So the article we've been talking about today came out of that research. And then last year, I was a departmental lecturer, so a fixed term. Uh, um, I'm sorry, yeah, it was a fixed term lectureship where I was teaching undergraduates and postgraduate students global and imperial history.
Hunter, there is this paper on Glasgow and financial markets. You have a paper on it too. Our practice as a superiority that enforcement bills of exchange and credit in 18th century Glasgow. I'm wondering if this is the paper I also wanted to talk about briefly. Somebody wrote a paper on
That's me.
Glasgow.
Yes.
Yeah,
Yes, I've written about credit enforcement mechanisms in Glasgow in the 18th century. That's right.
yes, I lived in Glasgow. I went to Glasgow to study and
Oh,
I
did you?
love the city. Yes, I went to the University of Glasgow to study.
It's a great place. I'm going up there next month for a few weeks to be a visitor at the University of Glasgow Law School, and I'm very excited about it.
Oh, really? Yeah, I've really so good. That so good. So you're going to be there for a few weeks.
Yeah, a few weeks exactly.
Okay, okay. So okay, before we wrap up, this is the name of the article. Andrew, Markham, and David Scarbeck. Why didn't slaves revolt more often during the Middle Passage? Sage Journals.
Uh, I've not read that article, but I'm looking forward to reading it.
Yeah, yeah. It's not well. Probably you can find a PDF link and read it for free, or use Glasgow's free access when you're there. That's what
Hmm.
I did.
Yes.
So as a Jamaican, I'm interested in Scotland. Around 30% of the plantations in the West Indies were owned by the Scots, and the Scots were the instrument of finance for the British Empire. Many of them were financial executives. So I'm really interested in Glasgow and Scotland and Stephen Mullins' research.
Yes, I know Stephen, and he's doing great work exploring the connections between Glasgow and the West Indies.
Yes, yes, yeah, he has. I didn't get to meet him when I was at Glasgow, but we have corresponded via email. And his book, his Glasgow Merchant book, it's an open access book, so people are free to read it. Yeah, but speaking to you has really been a pleasure. If you allow me, I'll speak for a long time because I'm really interested in history.
Well, you've got a good audience in me. I'm also really interested in history,
Yeah,
obviously.
I'm really interested in history, and I am so happy that Joel Mokyr won the Nobel Prize.
I think it was great for the field of economic history.
Yeah, exactly. And do you know why I like Joel Mokyr so much? Because Joel Mokyr is an economist. He's trained as an economist. He writes on economic history and economics. He's a quantitative academic, but many of his papers are not quantitative.
Mhm.
They're theoretical. Surprisingly, his theories are being replicated quantitatively. So there's a new paper by Debin Ma, Jared Rubin, and somebody else, and it compares the relevance of appreciating useful knowledge for development. So the comparison was between Japan and China. So that's a replication. And there was another replication pertaining to the ideas of progress and economic growth. So that's why I'm so happy that Joel Mokyr won the Nobel Prize.
Yeah, I think it's really good for the field of economic history to have a Nobel Prize winner, and also someone whose most well-known work isn't quantitative contributions, but
Yes,
as you said, theoretical ones, and I think kind of good old-fashioned historical work of finding evidence for what he's trying to say was important.
and what's so important about Mokir's research is that directly and indirectly he has taught us that education is not human capital. Human capital is a specific skill or expertise and it has to be applied. It's like being trained as an engineer, starting a business like Amazon, or filing for a useful patent. Mere education that won't lead to growth. And we're seeing many studies showing that schooling does not lead to growth because schools don't always impart relevant skills.
Interesting.
Because of Mokir, I've been thinking about all of these different issues. It's like England. England was literate, but Scandinavians were literate. They were smart. They were late industrializers.
Yeah, I mean, there's um, I think Milkier's work stresses the importance of knowledge and useful knowledge and institutions to transmit knowledge and foster it. But it also gives us a big task to try and ask, well, these literary and philosophical and technical societies existed in other places. So why did the Industrial Revolution happen in England first and not the Netherlands or Scandinavia, as you said, or France? Because that culture of knowledge seems to have been fairly widespread. But what else was going on in Britain that activated it?
The apprenticeship program. I'm laughing because England were the pioneers in effective apprenticeship, but today England is no longer the pioneer. Many of the apprenticeship programs in England are of a lower quality. There's a surplus of apprenticeship programs for people who, based on what they're going to be taught, won't necessarily become innovators. I think the Germans and the Danes are doing skills. Well, I don't think, based on what I've read, I know that other countries are doing skills based training better, which is quite interesting because the Brits were the pioneers. Like, I like England. I think England, even today, remains a pioneer. Up to last night, I was speaking to a friend who said that he likes England. It's really livable, but it's expensive in the sense that he was paying in taxes. So he's from a developing country.
Mhm.
He's of West. He's not black, but he's from a developing country, and he worked in that country, got a job in the UK because of his network in the other country. So he was traveling to the UK to meet people, and he got a job. And at some point, he was going to get visa sponsorship. He could have applied for the skills visa, but he said he can multiply his money in his country.
Mhm.
So the taxes were too much, and he likes the UK. He says that the UK is really livable. He likes the air quality, but it's a society that's underperforming.
Yeah, I mean, as you know, I mean, so many people have written about the UK's economic performance since the financial crisis and
Yeah, like
how it's
and
failed
you
to
live in the UK,
keep
right?
up with its trends. Yeah.
Or repeat what you just said earlier. I cut you off a bit. So repeat
Oh no,
it.
no, I was just saying, it's a real economic problem that growth in the UK um, took a serious dent after the global financial crisis and just has not caught up with pre 2008 trends.
Yes, and there are two important countries in the world: the UK and the US. It doesn't matter how people feel about the declining relative power of the UK. The UK is still an important country. London is in the UK. It's a home of important financial institutions. It's a tech hub. Some of the best science could still be in the UK. The problem again is commercializing. So these people, they're producing research, and then an entrepreneur from Germany buys the UK's product and it becomes a German product.
Mhm.
So it's a society with human capital that's just doing poorly.
Yeah, and it's a relatively small market. I'm from the US, and whenever I watch TV in the UK with advertisements, I'm always struck by how the production quality is so much lower because the US, you have a market of some 300 million people who can who can buy a product, where at the UK it's what, 50 or 60 million
Yeah,
that you're
do you
appealing to.
know? Do you know what's funny? I'm from Jamaica, but I've been to the U.S. before, and Jamaica is quite Americanized. So our supermarkets are flamboyant, and when you migrate to the UK and you enter Tesco or any other supermarket, you just want to drop.
Oh, it's true. You've probably felt it as well. You go into a UK supermarket and you think, oh, the quality of produce is not like it is at home.
No, what's that? Like when you're in American supermarket or even a Jamaican supermarket, you get what you want. You can go to a UK supermarket and you are looking for even a tablet and you can't find it. You can't find chips. Like what's that?
Yeah, no, I find that there's a lot of variation from store to store in the UK, right? Going into a Tesco is a very different experience to going into a Waitrose, where you can find anything you want.
Yeah, so yeah, that's really weird about the UK, but I'm sure you might have other things to do. So let me end this recording and thanks for coming on.
Well, thank you for having me. I've really enjoyed this conversation.
Yes. Oh.